Hi there, welcome to Kneppy Invests. I think it's time for another article reaction. And today I'll be looking at a buy, hold, sell series on Livewire. This was one of the most popular articles in Livewire over the past week, and it was a recommendation from one of the viewers. Buy, hold, sell 7 ex-20 stocks with strong balance sheets. Now, what's the definition of strong balance sheets? Or maybe you might say healthy balance sheets. And this is a pretty good question. Now, when I look at a balance sheet, I do look at stuff like debt levels, cash, inventories, how they're changing over time. Also look at the current ratio, which is current assets divided by current liabilities. And that can be quite important as well. And typically you want that to be at least above 1, preferably a little bit higher than that. Now, when it comes to current ratio, a few years ago, I had a look at a company called Mosaic Brands, and their current ratio was about 0.4. I was thinking, why is it so low? And that company has gone bankrupt. Now, I'm not saying they went bankrupt because the current ratio was really low. And I was trying to get some rationale behind why a company can exist on a fairly low current ratio. And what I did find was that those companies that have pretty high turnover, you might see their current ratio a little bit lower than what you might expect. And this comes back to a fairly important point that you can't compare all balance sheets for all companies equally. There's going to be differences. And when you have a look at some of the balance sheets of the companies that will be mentioned in today's video, and particularly if you focus on something like debt to equity, which is another good thing to look at in terms of whether a balance sheet is healthy or strong, you'll notice that there are a few companies in today's list that have a high debt to equity. And those companies are retail companies. And there's a reason behind that, because there was an accounting standard change about 5 years ago, I think it was, maybe 5 or 6 years ago, where leases were now considered debt and they weren't before. And that does increase these companies, retail companies, debt levels. And that's why when we have a look at, I think it's about 2 companies, maybe more, their debt to equity is quite high. So I'll show you one of those instances in this video. Okay, so typically in this series, they feature a couple of experts, 2, 3, sometimes even more than that. And today we have, where is it? Marcus Burns and David Allingham. So David Allingham is from Eli Griffiths and Marcus Burns is from Spheria. So they don't really go into companies or how they define as a strong balance sheet at all, which I would have liked, but they just go into whether these companies, and what it is 5 companies chosen by Livewire, and then each expert chose one of their own companies that they do like. So let's get straight into it. And the first company is Ansell. And Marcus Burns had a hold and David Allingham had a buy. I won't get into why, fairly short reasoning for some of these, but what is my opinion of Ansell? Now, I won't say whether I think Ansell is a buy, hold, or sell, because it all comes back to perspective and also what you consider or where you consider the company fits in the quality spectrum. For me, that's really important. Now, for Ansell, where do I think this company fits in the quality spectrum? I don't and probably would not consider Ansell to be a high quality company. And the reasons behind that, in fact, I might just show you. We'll go to FinChat. The main reasons behind Ansell and the reasons I wouldn't consider a high quality company is just the lack of growth and the very fact that return equity and return invested capital both less than 10. I consider those metrics to be quality metrics, in fact. So return equity, and this is a 5-year average, 9.8%, and return invested capital, 9%. Now, that's not really bad, to be honest with you, but I do prefer those to be a little bit higher. But it's really the growth. And if you have a look at the revenue growth, earnings per share growth, and even dividend per share growth over the last 3 to 5 years, particularly 10 years, not quite what I'm looking for. So for instance, revenue growth for Ansell is at 0.7%. So this is CAGR. Earnings per share at 6.9% and dividend growth over the last 10 years at 0.5%. Nothing you can do in FinChat, and I do like this, is if you have a look at the side here, they have this chart, and you can just change it from price, drawdowns, percentage change, total return, markup, enterprise value, and $10,000 growth. I do like to have a look at total return. Now, unfortunately, they don't have a 10-year option. They do have a max, but you can change your periods. And what I'll do here, I'll just change it to about 2015. There it is. So over the past 10 years, this company has given their shareholders a 7.1% return per year. So that includes share price appreciation and also dividends. And I do prefer that to be a little bit higher. So there are a few reasons why I wouldn't consider Ansell to be high quality here. And that's probably means I consider this company to be more of a trading stock. And that's exactly what I'm doing with Ansell right now. It's more of a trading stock than a company I would consider to own for the long term. Now, if you have a look at the chart, and probably I wouldn't say the laziest, but the easiest way to determine whether a company is high quality or not is just having a look at the long-term chart. What's happening here? The leap. So if we go to the weekly chart and go all the way down, in fact, what I might do here is just put in the 200-week moving average. If you have a look at the weekly chart, going back, you go back as far as you want. There are indications that this could be a quasi-high quality company because share price is going from the bottom left to the top right, but it's not a really, or hasn't been a really big increase in share price over a fairly long period of time. And we're going back 16 years here. But over the long term, there is a chance the share price will rise. So if you do buy this company when the share price is below the 200-week moving average, more than likely you will do okay. But in my opinion, this is more of a trading stock than a long-term hold. And that's what I'm doing right now. Bought some shares at $25.68, share price $34.45. No reason to sell at this point in time. Okay, so let's go back to the 7 companies and let's move on to the next one. The next one is interesting. So a little bit of divergence between the two experts with Lovisa. So David Allingham believes it's a buy. He calls it a high-quality company facing multiple short-term challenges. And David Burns says it's a sell. And David Burns' reasoning is actually really interesting. It is a high margin business, absolutely right, with few barriers to entry. That makes it easy for competitors to step in. But this has been true for Lovisa over the last 10 years, and we have not seen any competitors step in. And it's easier said than done. Like you and I apparently can step into this area and create our own Lovisa as a competitor to this company. But I don't think it's as easy as that. So I slightly disagree with Marcus Burns here. I do think there are barriers to entry. And Lovisa's, how they've set out their stores is quite unique, a very efficient set out in their stores. And I don't think it's quite as easy for competitors to step in to take advantage of that high margin business. And I'll show you the reason why. Now, yeah, it probably is high valuation, but I'm going to show you the reason why I might not be concerned about their high margins and the competitive risk. So let's have a look at Lovisa. Now, by the way, I am a long-term holder of this one, and I see no reason to sell out because I do think based off their plan to, I wouldn't say dominate the world in this space, they do have a rollout plan throughout the world. And at this point in time, it's going not as smoothly as what you would like, but it's still going or moving forward. Now, based off, before I have a look at the gross margin history, which I wanted to show you, would I consider this company high quality? Well, yeah, I do because I'm holding it for the long term. So why? So return equity, 79.8. Return on invested capital, 17. So you notice there's a big difference there. And we're going to have, I'm going to talk about the debt as well. Growth, fantastic growth. So we're talking about revenue growth exceeding 20% over the last 10 years, earnings per share at 34% growth over the last 10 years, and dividend growth, well, it's not applicable here, but over the last 5 years, dividends have been growing at 23.7%. But this is one of the companies where if you have a look at debt to equity, it's at 3.7. And the reason that the debt to equity is quite high, well, first the reason is the equity is really low. It's only like $100 million, which is the reason why return equity is so high, because the equity is really low. And one of the reasons why the equity is really low is because financials, or not financials, the leases are considered debt. And that is why debt equity is really high at 3.7. And I can just show you, I suppose. I could definitely show you. But before I show you that, actually, no, I'll show you that first, and then I'll go to gross margins. So if you go to balance sheet in FinChat, and if you go to long-term leases, you'll notice back in 2020, it just changed. Went from nothing, It doesn't go back further than 2020 because it went from nothing because how the accountants view leases to a really high level. And this would be an interesting debate. Now, I'm not an accountant, and I do know some accountants who, yeah, they do consider leases to be a debt. I don't know if I go down that road. I would consider debt is sort of the money you have to pay back the bank. And this is not sort of the case, but they do have to spend money for their leases. That's an absolute real cost. And that's another reason why when I do look at a retail company's cash flow, I like to include leases because it's not included in the operations of the cash flow statement, which I find extraordinary because this is something they have to pay because leases are a real expense, but it's not included in the operational cash flow. Anyway, so so the leases suddenly jumped up in 2020 from nothing because of the accounting changes. And last year, it's at about 246.7 million. So right there, 246.7 million of long-term leases versus equity of about 100 million. So that's the reason why this company has a large debt to equity. So I probably personally do or would ignore that. Now on to their gross margins. So Sean Burns just mentioned he's concerned about the gross margins and competitive pressures. So if there is competitive pressures, this company should be seeing their gross margins decreasing. So is it? That's the big question. Are the gross margins for this company decreasing? No, they're not. So this is the last 10 years history. In fact, they've been increasing. In fact, they've been increasing over the last 5 years after a bit of a dip in 2020 and 2021, which is to be expected. So this is exactly what you want to see. You don't want to see gross margins decreasing for this company. That would be a concern because it might be hinting that there is competitive pressures for this company. So I do disagree with Sean Burns when it comes to that part of Lovisa. Now onto another company I do own for the long term. That's Breville Group. And they've both got a buy for this one. And it's interesting because I might, even though I do own this company for the long term, I might slightly disagree with both experts here because I don't really think they're focusing on valuation right now. Now, yeah, if you can buy it at the right price, I think this is a great long-term buy. But at these prices where Breville is right now, I'm not so sure. Now, Marcus Burns says they have one of the best management teams in the country, investing heavily in R&D marketing, strong cash flow, and a rock-solid balance sheet and demonstrable market share. By the way, in FinChat, they do have a financial health section. And that does include, let's have a look. That does include cash, net debt, debt to equity, and EBIT to interest. And I do think some of those are fairly important. Debt, net debt, debt to equity, EBIT to interest are important. But I also like to look at current ratio, that sort of thing. And I think the only company that I might have had issue with current ratio would have been Lovisa, but that was a few days ago. Anyway, so all these companies, I don't have any issues with a balance sheet, but there might be other issues at play. So when it comes to Breville, it's just the valuation. So let's go back to what David Allingham says. He agreed with Marcus Burns, absolutely. The company reinvested COVID-era gains into product development and expansion into new geographies with strong leadership and a clear growth path. It set up for sustainable earnings growth. And I can't disagree with that, but it's just the valuation. So P ratio is at 34.5. If you have a look at some of the other quality metrics, return equity 16.5, return invested capital 16, exactly what I want to see. That's a 5-year average. Growth, pretty nice growth, 12%. 12% revenue growth over the last 10 years, earnings per share at 9.6%. Probably would like that to be a little bit higher, but that's okay. And dividend per share growth at 2.6%. That's okay. I wouldn't be invested in many of these companies for the dividend. That's not important to me. Anyway, but the P ratio 34.5, which I do find a little bit higher than what I would like. Now, when I did take a position in Breville, their P ratio, I think, was like 17, 18. And for me, that is a good level for this company. Now, if we have a look at the P/E ratio of this company, the one thing you'll probably notice, in fact, this is it. I might have been looking this last time I looked at Breville. You notice that over the last 10 years, the P ratio, if you take out that massive bulge back in 2021, when the market was willing to pay 60 times earnings, that's a little bit too much. You notice that over the last 10 years, P ratio has been climbing, which means the market is more and more willing to pay a premium for this company. Right now, the P ratio is at 35. It wasn't that long ago, the P ratio was above 40. And I did sell some shares in Breville because of that. It was looking a little bit stretched, the valuation of this company. So that's why one may concern about Breville, but I did not want to sell all my shares because my philosophy moving forward is even if I think these companies might be overvalued, there's a possibility I could be wrong. So what I'm going to do is when I think they're overvalued, I might pare back my positioning. And when I think they're undervalued, I might increase my positioning. And that is something that I have changed. Typically in the past, I just sold out completely and then might have bought back in at a later date. Okay, so that's Breville, 2 buys. And the next company also has 2 buys, Charter Hall. So David Allingham says, it's our preferred asset manager in the Australian market. And Marcus Burns agrees, as good balance sheet, strong property funds management, and quality assets. In fact, I'm pretty sure the building where the Bureau works out of in Brisbane is owned by Charter. I could be wrong. I don't know much about this company. So I did have a quick look, and there's a few things that surprised me. So first thing I'm going to show you, if you do have a look at some of the quality metrics of this company, you might be going, oh, I'm not sure. Return equity 12%, return invested capital on 49.7, debt equity 0.2, EBIT interest 10.2, nice levels of cash and not too high debt. Revenue growth 11.3%, earnings per share growth 1.9%, and dividends at 7.1%. And it's really interesting because then I went to the last 10 years just to see what sort of returns this company has given their shareholders over the last 10 years. And here we go. And that's 4 years. Let's go back to 2015. So over the last 10 years, it's about 17% per year. And you're going to take that sort of return. So we're talking about share price has increased quite nicely. And also you've been getting dividends. And that's exactly what you want, capital growth and also dividends on top of that. And if you have a look at the chart, so when I am unsure about a company, so I haven't shown you the Lovisa and Breville charts. So let's look at those right now. I won't because we're talking about Charter Hall right now. Charter Hall, looking at look at the weekly chart. Yeah, Charter Hall, this is actually almost particularly before COVID-19. This was actually a chart of a high quality company. And the reason I say that is if you just go like that, you notice that during during the GFC, share price did drop a lot. So there could be some cyclicality when it comes to this company. And then from about 2011, a beautiful chart, a beautiful trend in the share price. Share price remained consistently above the 200-week moving average, which is a sign of a high-quality company. And then share price really took off in 2019. And then, of course, a pair back, and then took off in 2021 and 2022. I'd say the valuation got a little bit ahead of itself in 2022, and that's the reason why we started to see a share price drop, on top of increasing interest rates. But since the lows in 2023 of $9, share price has almost doubled. So share price it's not at a point where I'd be willing to take a position in this company. Now, I actually did have very close to buying a position in Charter Hall when the share price broke out in August last year. Share price punched up 15.8% on their results, and that was a good sign that this could have been a good, at least a medium to long-term hold in your portfolio. And again, the question becomes, is this a high-quality company? I think there are some indications, definitely some arguments, this could be considered a high-quality company. Okay, so I completely forgot about the Lovisa and Breville chart. So I'll look at those now, and we'll go back to the weekly chart. So Lovisa share price is at an interesting level, very interesting level. And the share price is right on the 200-week moving average. And as Charlie Munger says, if you want to significantly beat the market, all you have to do is buy high-quality companies when the share price is near the 200-week moving average. And I've been looking at this, and I noticed that I bought a lot of American-based companies on the NASDAQ when the share price did get to these levels back in 2022. That's when I decided to buy or invest in the United States. And even though I've never heard of this rule before, I was actually doing it maybe subconsciously. Anyway, so Lovisa share price is right on the 200-week moving average. And we have seen the share price actually sort of that level. It's not really a level. It's a price. I don't know what you call it. So the 200-week moving average has been support for Lovisa over the last few years, in fact, the last 5 years, and we can see it bouncing off that level twice in the last 5 years. So it's only sample size of 2. It did go below the 200-week moving average during COVID-19, but that's to be expected. And even if you go back further, the share price actually bounced off that level in December 2018. So now might be a good time to buy Lovisa, just based off this chart. And Breville, by the way, I should put in where I bought it. I haven't done that for all companies I own. I bought Lovisa. Yeah, I bought Lovisa either back in June 2022 or either October 2023 because I did buy it at a fairly low price. Now onto Breville. And yeah, this is also a chart of a high quality company. Now, when I did buy some shares in this company, this was back in 2022, share price was consistently below that moving average level. So I bought some shares at 19.50. So this was would have been July 2022, so almost 3 years ago. And if we go back to FinChat, so July 2022, let's just have a look at what the P/E ratio was back then. July 2022, the P/E ratio, according to this, was about 22. So I thought it was a little bit lower. And that was the low in the P/E ratio we have seen for a while. Anyway, so that's the main reason I did actually bought some Breville, is because I thought the valuation was actually quite nice at that point in time, but I thought it was a little bit lower. Okay, so Charter Hall, I don't know if I could absolutely disagree with the experts here, but I would prefer the share price to be a little bit lower. But I'm not rushing out and buying Charter Hall at all. And finally, onto Supply Network, a company I wanted to own for the longest time, and I was just waiting for a big dip. The dip never happened, so I just thought I'm going to buy some shares at $30. So I remember exactly what price I bought at, $30. I don't think you could say this company is anything but high quality. It might be smaller than what you might want. Maybe liquidity is a little bit lower than what you might want, but there's no reason why you could even argue that this is not a high-quality company. I'll talk about Marcus Burns in a second. So I have disagreed with him on occasion in this particular article, but I'm going to give a bit of praise. So David Allingham just says, hold, excellent business, but valuation is something to watch. And that would be probably my main argument against Supply Network right now, is valuation. But you could have said the same thing over the last 5 years, maybe not that long, about valuation. Share price just keeps on going up. Market share gains are steady and they still have room to grow. Below that is already priced in, maybe. Now, Marcus Burns mentioned it's a buy. Market leader, aftermarket truck and bus parts, yep. One of the best organic growth stories in the country, which is something I absolutely love. So there's 2 ways to grow, organically and through acquisitions. Maybe there's other ways, but organically and through acquisitions. And I prefer companies to go down the organic route by far, because acquisitions can be company destroying. Yes, I'm talking about you, Slater and Gordon. Anyway, what he mentions then, and Marcus Burns has completely redeemed himself, sort of like Dumb and Dumber when he buys that bike. Anyway, Marcus Burns has completely redeemed himself because he's mentioned 2 things I absolutely love. And he says, one of the best organic growth stories in the country. Revenue has grown at 14 to 15% CAGR over the past decade. Yes, he's talking about revenue growth and CAGR over the last 10 years with no acquisitions. Absolutely great. Return equity is high at 35% and the balance sheet is strong. So he's talking about revenue growth and also return on equity. So Marcus Burns, you have completely redeemed yourself with Supply Network. And he's absolutely right. So he's mentioned those 2 things, which I always look at when I'm studying or researching a company. So Supply Network, when you do have a look, by the way, that's their P ratio. So P ratio of Supply Network is 40. So definitely some questions about the quality, but I think the market is starting to realize this is a really good company. And when it comes to the market and how they perceive companies, when they think a company is high quality, they're going to pay a premium. Now, within the last, I suppose before 2024, the high in the PE was about or below 30. And you can just see how the PE ratio has been climbing through time. And that's another good indication that this company's perception among the market has completely changed. So back in 2015, the PE ratio of this company was 15, if that. At one point, it was 12. It was 12. Now it's 40. So yeah, the market definitely considers this company to be high quality. And I don't think you're going to see the P ratio climb like we've seen over the past year. Anyway, so let's go back to the overview of this company. Supply network. Okay, so gross margin. Always look at gross margins. Really haven't mentioned gross margins apart from Lovisa, but I do like high gross margins, 43.6% for this company. Return equity, 35%, as Mark Spoon says. Return invested capital, 22.6%. And if you have a look at the financial health, all good. Debt to equity 0.4, EBIT to interest 23.5, not a lot of net debt, only 29.64. Revenue growth 10 years 14.7%, earnings per share at 18%, and dividend per share growth at 21.9%. But the most important thing here, when you look at the growth, they're accelerating. So if you look at 3-year, 5-year, 10-year, even probably 1 year, growth is accelerating, and you can sort of see that in the chart for this company. So let's have a look at the chart. And yeah, I didn't buy that long ago. So I bought it $30. So this would have been maybe 6 months ago. And I just had to because I was waiting for a dip. And you don't see much dips for this company. So this is the weekly chart. Now, just beware. So you'll notice if we go back, you'll notice that the share price of this company has been above the 200-week moving average since 2010. And only once has it gone below the 200-week moving average, and that was during COVID-19. And only fell through for a slight period. So this is like the perfect chart. So you buy this company when it hits a 200-week moving average. The problem now is the share price is well above that average. In fact, share price now at 35.62. And the 200-week moving average is about 18. So there's a possibility share price could halve and it still be, well, maybe not half, but you know what I'm talking about. So share price could almost halve and it'd still be above the 200-week moving average. The other thing I like to look at is just volume. And you notice the volume has been steadily increasing over the past 10 years, and that's very important. So more and more fund managers are getting interested in this company. Liquidity is improving, and so more and more fund managers will remain interested. Okay, so 2 more companies to talk about. And the last 2 companies have been chosen by the experts. And David Allingham chooses Temple & Webster. This is interesting because I do have serious valuation concerns about this company. But the management do have aims, and he's pointed that out. Management aims for $1 billion in revenue with 15% EBITDA margins. And we think they can surpass that. So if they can surpass that, there is a possibility that the company could be undervalued. He doesn't give a time frame here, so maybe I should take a closer look at the company. Maybe presentation or something. Now, I should also mention I own Supply Network for the long term, and I am trading Temple & Webster, which means because I'm trading it, I don't consider this company to be high quality. Now, has the potential, definitely, but right now, I don't think I could consider this company to be high quality. And I think there's definitely a possibility share price could be quite volatile, could go up and down a lot because it's hard to really value this company because the profits are so low right now. Now, profits more than likely will increase significantly, but they are really low. So let's have a look at some metrics for Temple & Webster. So it's really weird because, online retail of furniture, asked me 8 years ago, maybe 8 years ago, whether this sort of business model could succeed. I'd say, no way. People want to go to the store and check out the furniture. That's what I thought. Anyway, so market cap is $2 billion. P ratio is 310. So again, earnings are really low, but they're on a low base. So there's a chance that the profit could increase 2-fold, 3-fold, 4-fold per year over the next few years. There's that possibility. Now, return equity is at 10.7, return invested capital 15.1. I would prefer that to be a little bit higher, but it's okay. Financial health is fine. Revenue growth, 39.1% over the last 10 years. Earnings per share growth over the last 10 years is not applicable because they weren't profitable. Over the last 5 years, only 11.9%, and no dividends. So if you want dividend-paying company, this is not for you. So really, it's just valuation for this company that I would be concerned about. And because I do think there's definitely questions about this company being overvalued, and I don't think this company is high quality just yet. So if you have a look at this particular weekly chart for the company, you'll notice how volatile it can be. share price can go well above the 200-week moving average and then fall quite below the 200-week moving average. And that could still happen. And right now, the share price is well above the 200-week moving average. And who knows what's going to happen? It could fall a fair bit. So I'm way more likely to trade this than anything else. And I did buy on a good financial report back in August last year at $12. So share price has increased 33% since then. And it could increase another 33%, or it could drop 50% from here. And that's why I do trade these sort of companies. And finally, we have Eagers Automotive from Marcus Burns, the leading car retailer in Australia. Someone did mention to me that they hold the BYD franchise, and I think that's very important for this company. And that's why they've got some tailwinds behind the company, because the other two ASX-listed companies, selling companies, retail companies, Peter Warren and what's the other one? Auto Sports, something or other. They both released negative updates. And I thought, the market's not seeing anything negative when it comes to Eagers Automotive. And I think that's because of BYD. Our company has $880 million in property assets. And I'm pretty sure they do own most of the properties they have their dealerships on. I could be completely wrong with that. And strong cash flow, making it a great investment. Now, I don't think I could ever call this high quality. So let's have a look at some of the metrics when it comes to Eagers Automotive. So valuation, market cap is 3.95 million. Enterprise value, 7.17 billion. So straight away, they must have fairly big net debt. So net debt is 3.19 billion. So yeah, that makes sense. So the enterprise value minus market debt should equal net debt. Doesn't quite exactly here, but it should. Debt to equity 2.5, so that's interesting. I'd probably like to research that a little bit more. Return equity is 21.3. That's nice, but return on invested capital is 9.2. The reason why return equity is much higher than return on invested capital is because debt isn't included in return on equity. In fact, if you had management who just had return on equity, remuneration goals, they would significantly increase the debt to get or to raise the return on equity. And return on invested capital, I think in this case, is a better look, but still 9.2. Probably would prefer that a little bit higher. Revenue growth, 10 years, 14.6%. Earnings per share at 6.8%, and dividends at 10.6%. So I think you could argue with me that this is a quasi-high quality company. Now, let's have a look at a chart for this one as well. And I think this chart is, okay, so that's the daily chart. Let's have a look at the weekly chart. Yeah. So, yeah, this is not really the chart of high quality. Well, it does go from the bottom left to the top right, but you can see a lot of volatility within that. So you could say there's a bit of cyclicality when it comes to this company, but it's not the classic high quality chart you do like to see. Not like Supply Network, or not like even Lovisa, those sort of companies. So even if you do buy near the 200-week moving average, there is possibly share price could fall even further, even much further. Anyway, by the way, I would also say that I was very close to taking a trading position in this company, even though share price was in a downtrend. This was back in May, June last year, just because I did think there was some value at those levels. And am I kicking myself? Yeah, share price has risen 60% since then. Why not? But there's a lot of opportunities in the market. Anyway, so funny enough, I do own quite a few of these companies. So I'm trading Ansell and Webster. Don't consider those companies to be high quality, definitely trades. I do own Lovisa, Breville, and Supply Network for the longer term, and I do like all three companies. And I do have some concerns when it comes to valuation, particularly when it comes to Breville, even Supply Network. Not so much with Lovisa, but yeah, there. Charter Hall, I don't know as much as probably the experts do, but I was surprised how good the returns have been for that company over the last 10 years. 17.9% is actually quite good. And Eagers Automotive, I think this is more of a trading stock, maybe. Yeah, maybe. Anyway, so that's all I have for this video. Looking at what it's called, Livewire's buy, hold, sell 7 ex-20 stocks. Ex-20 stocks with strong balance sheets. What are your thoughts? Are these the sort of companies you'd like to own for the long term? Or you think some of these companies are absolutely crap? I'd love to hear your thoughts, so leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.